VIX to 150. This time is worse than the 1929 Great Depression. This year has been among the worst, if not the worst, in several generations for diversified investors. The last month only served to make things worse. The Federal Reserve may find themselves in a more difficult situation relatively soon. Interest rates have risen extremely rapidly, and we have a lot of debt in the system. So we have to be mentally prepared for something breaking and potentially force the Fed to pivot in some way. If history is any guide, there's a good chance that we will see credit spreads widen significantly before all of this is over. Big driver of inflation is wage growth, and the strong labor report on Friday told the markets that most likely the Fed still has a lot of work to do. Just like Michael Burry said, the Fed is so afraid of being the Fed from the 1970s that they are becoming the Fed of the 1930s. What does Burry mean by that? What happened in the 1970s? Are we heading into a depression? Do I think the Fed will pivot anytime soon? Will the VIX actually surge to 150? I will let you know right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these markets, please consider subscribing. And of course, tap the like button. It's totally free to do so if you like what you see in today's video. If you like any of these topics, you are intelligent. That's why you're here. You know what to do. And push my button, because I can't push it from this side. If you are a sweet boy, go to patreon.com/magicalgoddesscheryl to support all my work. If you want to be my good boy, apply to write your first book with me, author of best-selling books, Goddess Cheryl. My good boys always obey, and they always get rewarded handsomely. Have you been a good boy? You will get the encouragement you need to be on your author journey. We are getting to a point where bonds are starting to look attractive from a long-term valuation perspective, but if interest rates are still rising, that makes investing in bonds very difficult. Given inflation is our problem, it makes sense to compare the present day to the high inflation period of the 1970s. Check out this chart from 1973 to 1975. It's a daily chart of the 10-year yield divided by the S&P 500. This is the massive and painful bear market in 1973 to 1974. Very similar to the financial crisis and the dot-com bust of 50% magnitude. S&P 500 bottoms here in October of 74. You can see when it bottomed. The ratio over the 10-year yield relative to the S&P 500 starts to go down noticeably. When the market really starts to rebound, the ratio starts to drop. Today, since the ratio is above all of the moving averages, we look like the period when the market is going down relative to after it rebounded. Unfortunately, you can make an argument it looks more like here before the bear market really accelerated to the downside. The takeaway here is when the 10-year yield going up, that means inflation expectation is going up. If you bet on deflation, you want to see the 10-year yield peaks and start to head down. It's fair to say from a historical perspective that the VIX isn't saying the bear market is over. There is an option trader paid close to $1 million betting the VIX will surge to 150. Right now, the VIX is only around 30. Shortly before the market closed, a trader, most likely one person, bought 50,000 call options, paying $950,000. Bet that the VIX could increase to 150 by late March. That was the biggest options bet for fear gauge on last Thursday. The highest the VIX has ever traded on an intraday basis was $89.53 on October 24, 2008, according to Bloomberg data going back to 1990. So this trader must be sure that this time is way scarier than 2008 financial crisis to spend close to $1 million on a fear gauge call, because if we are just going down slowly as we currently been going down, the VIX can stay around 30 to 35 range. It has to be a significant amount of fear, probably a world breaking or nuclear war type of fear, to spike the VIX above where March of 2020 or October of 2008 has been. Michael Burry recently tweeted, "Margin leverage isn't what it seems because options. VIX isn't what it seems because futures. Consumer credit isn't what it seems because inflation. QT is exactly what it seems." What Burry is saying is that starting 2008, because the Fed bailout AIG, the insurance company that sold protection for the subprime mortgage-backed securities, they started to sell quote guarantee investment products that short the VIX or pushes the VIX down, so that it drives more people to buy and paying them fees. When the real fear come back to the market, when the Fed can't bail them out this time, the VIX will spike higher than never before, because QE pushed down VIX. QT spiked the VIX up. Right now, Jay Powell thinks he is the reincarnation of Chairman Volcker. QT will create debt spiral depression worse than 1929. A big rate hike is 80% certain in November. Markets need to abandon hope of the Fed put after the September jobs report, and another jumbo rate hike is all but certain in November. Another hefty rate increase by the inflation-fighting Federal Reserve appears on the way, and stocks will likely take further hits in anticipation of the move. But investors should set aside the notion the Fed is looking to steer equities away from sharp declines. Investors after the September payrolls report were pricing in a more hawkish outlook for the Fed's likely rate hike in November. The CME FedWatch tool showed an 82.3% probability of a 75 basis point increase, up from 75.2% a day earlier and higher than 56.5% a week earlier. I think the Fed feels like they have the license to push ahead aggressively to combat inflation. Department released its payrolls report on Friday. The U.S. created 263,000 new jobs in September, beating the 250,000 average estimate. The unemployment rate fell to 3.5% from 3.7%. U.S. stocks tumbled after the jobs report. The Nasdaq Composite lost nearly 4%, and S&P 500 gave up nearly 3%. Today's jobs report likely does not change the Fed's calculus in its fight against inflation, which is still on track for another 75 basis point rate hike in early November. The report could lead to new 2022 lows for stocks this month, Bank of America said Friday. The U.S. stock market is already submerged in a bear market, with the Nasdaq Composite off by roughly 32% this year and the S&P 500 down more than 20%. The Fed has been aggressive in raising interest rates to pull down inflation that's sitting around a 4-decade high, and in turn, that's left equities in the red. On a variety of metrics, I think there's definitely still downside, particularly because I don't think there's any sense the Fed is trying to help the market. The Fed is focused on inflation, which is different from some other situations where you have an economic crisis or a financial crisis. A Fed put refers to the belief among investors that policymakers at the U.S. Central Bank will enact policies aimed at aiding stocks if they drop sharply and quickly to worrying levels. The market saw Fed puts in 1987, 2010, 2016, and 2018. Siglali said garden variety bear markets running back to the 1929 crash on Wall Street have lasted between 10 to 12 months and have taken stocks down about 33%. I don't think Fed policymakers are thinking that the market has come down so dramatically that they now suddenly need to pivot. He said back in 2018, when the market reacted very poorly to the prospect of potentially tightening, they did actually take the market into account. But that was when inflation was not a problem. I think now you're exactly in the reverse situation where inflation is suddenly a problem and the market is simply going to be collateral damage, including concerns about the health of Swiss lender Credit Suisse, the Bank of England's emergency $65 billion bond market intervention. That glimmer of hope, there might be a little bit of a pivot, not anything near resembling an actual easing of monetary policy, is being priced out. We're retesting the June lows, which ultimately is something that we probably need to do anyway if there's ever hope of reaching a major low in the market. When the VIX goes up, Treasury bond will go up. When the VIX goes up to 150, TLT will spike to 190. Okay, now I'm going to show you Juliana Wood's Burning in the 2020 Flames book. This is such an amazing book by my client, Juliana Wood. And my client, Taddy Eazzy's Wicked Pussy Perfume. It's an erotic novel, another incredible book. And my book, it's a bestseller, this one. Outstanding book, this one. And back then, my hair was red, so you can see there. This is when I had the red hair. I really like it too. Let me know what you think in the comment section below. If you like me with red or if you like me with blonde. And my book, You Hold the Magical Key to Your Success. This is so amazing, this one. And we really do hold the magical key to our own success. So I thank you for watching. Thank you for being a fan and for supporting me. I really appreciate all the comments and everything. Bye.